Good afternoon, everyone, and thank you for joining us for today's session. Hope your day's been a good one. My name is Vito Dintrono. I'm Yarra Capital Management's Chief Commercial Officer, and I'm delighted to welcome you to this afternoon's webinar with Dion Hershan, Head of Australian Equities, and Marcus Ryan, Senior Investment Manager and Co-Portfolio Manager for Yarra's Real Assets Strategy. Very shortly, the guys will take you through what is a really interesting presentation detailing the firm's views on the Australian office market, including a discussion on whether working from home, an expression we're all very familiar with during the COVID-19 pandemic, is set to reshape the domestic office landscape. Before we get started, just a couple of housekeeping items. Firstly, you're listening to this webinar using your computer system by default, and all participants are in listen-only mode. Importantly, questions can be asked at any time during today's presentation just by typing them into the question pane of the control panel. Just look for the question mark symbol, and we'll look to address as many questions as we can at the end of today's formal presentation. The structure for today's session, mainly we'll hear from Marcus for 15 to 20 minutes before turning to Q&A, and as I said, please keep those questions coming. As always, we aim to wrap up a little after 3:30. So for now, I'd like to hand over to Dion Hershan, who's going to introduce today's topic in further detail. Thank you, Dion.
Thank you, Vito. I'll start by saying the outlook for property is topical. We all know we're in a complex economic environment, and for that matter, a complex economic investment landscape as well. The holy grail in many respects is actually trying to find businesses and assets that are stable, defensive, and can generate good income in a world which appears to have structurally low interest rates for the foreseeable future. Physical property for most of the last decade was exactly that safe haven. It was a massive beneficiary of the fall in interest rates, with valuations stretching dramatically and demand from a solid economy and reasonably tight supply in most asset classes, pushing up rent, which in effect created a virtuous circle. In recent years, there's been a pretty intense focus and debate on what's been happening with shopping malls, but the surge in online retail, the profitability challenges of retailers, the spike in bankruptcies pre-COVID, and more recently COVID, has created a clear consensus that shopping malls have both structural and cyclical challenges. The value of those assets has started to drop quite dramatically. Most recent valuations are down 10 to 20%, and we think that's the start, not the end of the journey. And the trusts that own these assets are selling at very steep discounts to their net tangible assets. In effect, the virtuous circle of improving occupancy, rent, lower incentives and valuations has quite sharply turned into what looks like a vicious cycle. However, to date, there's been very little debate and scrutiny of how the office investment market landscape actually looks. It's a large asset class with close to $200 billion of assets in Australia. It's largely held by industry funds, sovereign wealth funds, insurance companies, and property trusts. Marcus will lead the discussion today, but what we're going to contend is that the wind had already changed on this asset class before COVID. The perfect conditions which existed for the better part of a decade were already starting to look fragile. But with the onset of COVID, it's pretty clear that there's a seismic change that's taken place. There are clear cyclical challenges that emanate from just being in a deep recession, but also some pretty significant structural challenges associated with what happens when work from home becomes an embedded way of how people think and operate rather than a fringe alternative. In summary, these are clear headwinds for both demand, and there are also issues associated with the supply of the office market. In summary, we don't believe the office asset class is a safe haven. We don't believe it's a stable source of income going forward, and we've reflected this broadly across our portfolios. In summary, if we're looking for yield, we're a big fan of infrastructure assets at this point in time. We have a very cautious position on REITs. So with that, I'll hand over to Marcus, who'll talk you through the analysis that's been undertaken. Over to you, Marcus.
Thank you, Dion. I plan to spend the next 15 to 20 minutes talking through our outlook for the Australian office sector, and then I'll pause and Dion and I would be happy to take any of your questions. Let's start on slide 3 of the deck. So the context of the conversation is important today. Building on Dion's introduction, we'd contend that the state of the Sydney and Melbourne office markets leading into COVID were frankly the best in 30 years. Vacancy rates at 30-year lows, rents over 5 years up between 50 and 100%, depending on where you are in the Sydney and Melbourne CBD office markets. Today, COVID has caused the fundamentals to shift markedly. The capacity for the industry to absorb what we would describe as a wall of increased supply over the next 3 years, and we'll go into this in the deck, has been materially impaired in our view, as tenants downsized due to both the cyclical and structural reasons, namely the working from home movement, forced learnt through COVID. Point 3 on the slide highlights that while the working from home outlook is difficult to forecast, our analysis would suggest that it's underappreciated as an investment risk. Our central case, for example, in Sydney, is that rents over the next 3 years would fall 35 to 45% as a result of weakening leasing tension, largely as a result of the working from home dynamic and that increased supply. Finally, from an investment perspective, our broad cap portfolio has a large underweight to the REIT sector, unsurprisingly at almost 5%. Let's now move to slide 5, the pre-COVID world. So we highlight here on the slide the future vulnerability of office markets given their near perfect conditions pre-COVID. Let's look at the charts. It was literally peak everything. Vacancy rates down to 3.4% in Melbourne, 5% in Sydney. The bottom chart shows the rental movement. Rents in Sydney over 5 years, up until the end of last calendar year, up 87%. Now, to be clear, these are net effective rents, so they take into consideration the lowering of incentives in the marketplace as well. Moving to slide 6, we show here that these peak office fundamentals translated into all-time record capital values. Let's look at the chart on the bottom left-hand side. We can see here that capital values broadly doubled over 5 years, as these record rents were met with record low capitalisation rates, as shown in the chart on the top left. In the listed equity space, this is effectively equivalent to a scenario of capitalising a cyclical company's peak earnings on a peak multiple. Turning now to slide 7, elevated supply. Elevated expected future supply underpins the vulnerability of office markets even before COVID struck. In response to higher rents and values, construction activity had picked up markedly. The charts on the left-hand side demonstrate this. As we sit here today, both Sydney and Melbourne are bracing for around twice the level of normal supply to hit over the next 3 years. And you can see that in those percentages highlighted red for 2020 through to 2022. As an example, let's focus on Sydney. What we're talking about here is over the next 3 years, an average of 90,000 square metres of supply to come to the market. That's equivalent to 1.5 Governor Phillip Towers per annum, broadly double what we've seen in the past. Let's now have a look at the COVID impacts. Slide 9. A view of what's happening with demand. So in what we consider an ominous sign of what may be to come, we note the recent industry data for the 6 months to this June, and it's highlighted in the charts with the red circles. It shows that office demand has slumped to the worst annual run rate on record, similar to the contractions that we saw in the 90s recession. So let's build this out. Chart at the bottom left. Melbourne lost 50,000 square metres of tenant demand in the 6 months to this June. That's the equivalent of 2/3 of 101 Collins Street. Interestingly, the industries driving this reduced demand is really quite broad-based. We're seeing it from services, finance, and the education sector. Importantly, in our view, the majority of the pain has actually been delayed, given the fact that leases are on average 5 years in duration. Moving now to slide 10, where we move into the working from home dynamic. We provide here an overview of the potential headwind to future demand based not just on the cyclical business outlook, but explicitly due to the new post-COVID dynamic of working from home, which we're calling the structural component, akin to the e-commerce effect that many of us have discussed in relation to retail shopping malls. Now, frankly, while it's difficult to be precise on the adoption of working from home, leading to reduced space demand for physical CBD assets, what is clear is the significant impact should it occur in a meaningful way. So our base case is shown on this slide, resulting in a 1.5% hit to the overall demand per annum for office space. Now, given that leases are 5 years on average, that speaks to a 7.5% total demand impact over the full 5 years. So what the chart shows us is, let's start on the left-hand side, 100 square metres of occupied space. And it ends the year with 98.5 square metres of occupied space, owing to this working from home dynamic impacting the renewing leases. Within this base case, we assume that the working from home movement impacts only the renewing leases. And as you can see in the first bar on the left-hand side, that's around 20% of the leases. We assume then that 75% of these renewing leases adopt what we call a working from home approach. Now, this working from home approach assumes that workers are not going to be in the office 1 day per week, with a 50% reduction in space requirement for this absent day. This could also be stated as implying a 50% assigned seating ratio, a seat that can't be utilised when the worker is at home. Moving now to slide 11, the vacancy scenarios. So unquestionably, the working from home dynamic will lead to increased vacancy rates. The chart at the top shows the degree of increased forecast vacancy based on the level of the working from home adoption. So under our base case scenario, you can see in the red, the Sydney CBD vacancy rate lifts to 13.6% by the end of calendar 22, up from the 5% level that we observed at the end of last calendar year. As you can see in the chart, this would be a vacancy level that we haven't seen since the aftermath of the 90s recession. Moving now to slide 12, we build out here the implication for rents and values. While it's hard to be precise, as all office cycles are different, our medium working from home scenario is summarised in the top here, in the top table here on the right-hand side. 35 to 45% lower net effective rents. As mentioned earlier, that's the combination of lower face rents and higher incentives, and 30 to 35% lower values for the 3 years ending December 22, which would frankly reverse much of the last 5 years of supernormal returns from this asset class. Relative to the prior 3 major office downturns of the last 30 years, and you can also see them in the table, what makes this cycle different would be these 3 things. We can see elevated supply at around 5% over the next 3 years for this cycle. We can actually see a similar demand shock, assumes about a 3% aggregate hit to demand over the next 3 years, and if you compare that to the prior downturns, it's reasonably comparable. We do, however, assume less cap rate expansion from the impact here. And that's given the low interest rate environment today and the ongoing thirst for yield above reference rates. Slide 13, we assess the bookends of our outlook. Given the ongoing uncertainty for forecasting the degree of working from home, this slide helps summarise what we think are the sensible bookends, assuming a high working from home scenario, which is 2 days per week, and assuming a no working from home scenario. And the outcomes are pointed at with the red arrows here. Clearly, they're highly sensitive. A high working from home scenario points to rents down potentially 50% plus, while the no working from home scenario has rents down only about 20%. And once again, we're talking about over the next 3 years. Moving now to slide 14. So clearly our outlook is being underpinned by this medium working from home outlook, which impacts demand negatively about 1.5% per annum. We provide here some real life examples of how some firms may be approaching this working from home dynamic. What is clear to us is that there's at least a willingness for more flexible working from home. The severity, you can see in a number of examples, even some headlines suggesting full flexibility where staff can choose where they work. And frankly, it's difficult to know exactly where it lands. And hence we think it's a sensible outcome to say that 1 day per week is probably a sensible placeholder as we move forward. We move now to slide 15. Workspace ratios have been a point of contention and discussion as we've gone through this work. What is clear is that over the last number of years, workspace ratios have reduced across key office markets, Melbourne and Sydney. We show an example in the top left here. This is the Australian government and how many square metres are being occupied per employee over time. So clearly, workspace ratios have been falling. Any permanent shift, we would contend, in an upward revision to the workspace ratio would lessen the impact of the working from home dynamic. Our view at this stage is that post-COVID, it's not clear at this point that that will occur. It's definitely an area that we continue to monitor. Which takes us now just to the conclusion slide 16. So to recap, clearly we retain across the portfolios an underweight to the REIT sector, and the broad cap portfolio, it's around 500 basis points underweight. We've looked today at the perfect state of office markets pre-COVID and how this has led to the current state of vulnerability. And as discussed, we contend and highlight here in point 3 on the slide that the impact from the working from home movement on the office sector, it's difficult to forecast with precision, but it is underappreciated as a risk. Our central case is that demand falls that 1.5% per annum, and that outlook isn't fully factored, particularly in consensus earnings. I thank you for your time, and I'll now hand it back to Vito.
Many thanks, Marcus. Okay, now time for Q&A, and thank you for those that have sent questions in already. There's plenty of time to continue to send questions, so please do so. Marcus, we might open up with you. And the question is, if you are right, who owns assets and who gets hurt?
Yeah, thanks, Vito. Good question. Look, our sense is that as a general comment, the pain will be skewed more towards secondary assets and therefore private owners who own more of this grade and cohort of office. I think it's important to differentiate office into its categories of prime and secondary. So prime is about 70% of the market by value, secondary 30%. And it's interesting, but we would contend that the REITs and large-scale institutional owners get slightly less hurt given their skew to the higher quality assets. For example, the REITs, around 95% of their asset base is in prime. Vito, the last point I'd make is just a conversation around Australian and overseas investors. I think the pain will be equally shared between those two cohorts. Looking at the data, historically there's about 6 billion of asset sales, office asset sales per annum. And if you look at the last 2 years, we'll call them the peak of buying conditions. we've seen that about 50% of the acquisitions are domestic, and that's in line with the historical 10-year average.
Great, thank you. Just a follow-up question, Marcus, and this question really centres around shopping malls and office assets. And the question is, would you prefer to own shopping malls or office assets?
Yeah. Well, I guess it depends on the price you're paying, Vito. That's the first point. But no, look, to answer your question, it depends. At a high level, in absolute terms, we think both asset classes face structural headwinds, making positive capital returns difficult in the medium term. You know, we've discussed in other forums the impact of e-commerce on retail, and clearly that's coming home to roost, evidently, particularly in these June round evaluations. We've now got working from home with office. I think what becomes even more important now is the asset level analysis, specifically what's the location, what's the tenancy mix, what's the leasing profile. The other point I'd make is just when we look at malls versus office, what devaluations have happened to date, and also then just recalibration of future expectations. In some ways, I do feel that the retail shopping malls are ahead of office in terms of both the devaluation cycle and the recalibration of expectations. And yeah, just to flesh that out, so we'll probably see this June from a valuation perspective, malls off anywhere between 10 and 20%, whereas quality office, might be off at worst, low to mid single digits. So look, yeah, just I guess to round it out in terms of expectations, it feels like the challenges for retail malls are very well understood, and we're still at the early stages of what the impact of working from home could mean on office.
Right, thanks. One for you, Dion. The office market aside, do you see any other value in the REIT sector today?
Yeah, I think Marcus hit on a couple of observations. We'd say there's three main areas of the property market that are listed, and then there are a few niches. Shopping malls, I think I endorse Marcus's view. It's simply too early to step in. The devaluation and leverage cycle is only starting to play out. Office assets, I think it's going to take some time, frankly, for these issues that we're forecasting to play through, and we think it's premature to get involved. Third major asset class is industrial assets, e-commerce related warehouses, and that sector is obviously booming. Where we grapple is trying to find attractive investments given the valuations in those sectors. So where we tend to own is things are a little bit more niche in nature. We've got some assets in property trusts that focus on hospitality with good counterparties. We own some retailers that are exposed to big box retail, which I think is going to fare much better than shopping malls. But on balance, we tend to be underweight those types of companies across the portfolio.
Thank you. Another one for you, Marcus. What if there is a vaccine? Does your thinking change?
Thanks, Vito. It's a good question. Look, our view, and specifically our view here on the outlook for office markets, let's be really clear about that, and we'll keep the context there. Our view doesn't change. It would, however, be more negative if a vaccine or some other way of having its return to the office is not found. So it is important to call out that our views that we've discussed here today on the call do actually assume a return to the workplace in a sensible period. Now, what is that sensible period? It's months, it's not years. We also assume in our discussion today that there's actually a healthy underlying employment improvement over 21 and 22. So, for example, embedded in our analysis today is the assumption that unemployment in calendar 22 goes back to 6.1%. So, look, yeah, necessity is the mother of invention. Vaccine availability, even if it's in the December quarter of this year, in our view, it's still allowed sufficient time for organisations to understand and then implement working from home approaches in really short periods of time. And that's what underpins our more cautious outlook, given what that does to the working from home. So the tools have already been learned for working from home, and that's what underpins our outlook.
Great, thank you. Perhaps one last one, Dion, given that we're nearing 3:30. Question is it counterintuitive to hold a negative view on office REITs, but a positive view on banks, which presumably are large lenders to this part of the market? How concerned are you about the potential for some larger defaults to impact the Big Four?
Yeah, I can understand that optically it might look like it's a disconnect, but it gets to really two aspects, one of which is materiality for the banks, and I'll talk about that. The other of which is protection for the banks when they do lend into these sectors. We'd start by calling out most Australian banks are actually quite diversified businesses, and their principal asset class is mortgages, and for your average bank, that probably represents half their loan book. And we actually think that's well secured and can withstand what's going to be a pretty rough 2 to 3 year time period. But to focus on office assets in particular, they're actually a very small asset class or loan class for the big banks. Ballpark, it's probably 1 to 2% of their loan book would be in office properties. Typically, they are extremely well secured with a loan to valuation ratio of 50% or below. And what you'd also find is even if Marcus's predictions are correct around the forward rent rolls and occupancies, given interest rates are so low, most of these tenants would still be able to effectively service their debt, or asset owners rather than tenants, I should say. So the way we'd sort of think about it is small part of the loan book, well secured. The risk here is probably for the equity holders of these office assets rather than the banks. Would also point out for a lot of the development assets which are in the office market, which is probably the riskiest part of this whole discussion, because not all of them actually have tenant commitments. A lot of that's actually been funded by shadow banks and specialist lenders, which is the polite way to describe a shadow bank. And they've been taking higher LVR loans with lower levels of security. And to the extent that there's a vulnerability, I think it might actually sit outside of the big four banks in the first instance. So overall, we'd say this is a slight negative to the banking sector, not enough to change our overall constructive view.
Great, thank you. That brings today's session to an end. Thank you to Dion, thank you to Marcus, and a massive thank you to everyone that's attended today's session. Your support is greatly appreciated, and we're here to help going forward. If you have any questions in that regard, please contact myself, Nick Green, or Amel Akopian in the first instance. More than happy to answer any questions or arrange follow-up meetings with the team. Couple of things, please keep an eye out for our next session invitation to come out shortly. And following today's webinar, there's a survey that will be sent out shortly also. Any feedback greatly appreciated. Finally, on behalf of Yarra Capital Management, a massive thank you for joining us today. Have a great afternoon and stay safe. Thank you.